Not everyone is as lucky as Santosh, who hails from Baroda. Back in October and November of 2021, there was a lot of IPO buzz in the market. In 2021, 53 companies had raised 1.12 lakh crore rupees from IPOs. Startup IPOs were like lottery, as Zomato, Sigachi and Nykaa had bumper listings, and Santosh's investment just doubled in weeks. But what do lakhs of people do when they don't get any allotment? And the ones with Paytm or Fino Payment Bank have had a very hard luck on the listing day. Those who got the allotment lost a large portion of investment on the listing day itself. But this is how the stock market behaves. If you did not get any allotment in the IPO, or if you're a bit scared after seeing Paytm's condition last year, then there are other ways that are relatively safe to own shares. Buying and selling shares in the buyback of companies and earning profit is called arbitrage. In simple words, the reverse of IPO is a buyback. In an IPO, the company sells its stake. However, the company buys more stake in a buyback. In recent years, many companies that had good cash, instead of paying dividends to shareholders, bought back their stake, with many investors becoming rich. But why do companies do a buyback? Well, that question is quite reasonable. Through a buyback, the number of shares in the market gets reduced, and this really increases the price per share, which is called an EPS, or earning per share. You must watch Money9 on EPS to understand what exactly it is. One is the tender offer, on which the company buys the shares from its existing shareholders at a fixed price. The shareholders have to decide to sell the shares back to the company by a specified date, which is called the record date. The second is an open offer, in which the company buys its shares through the stock exchange or by a book building process. Promoters cannot be involved in purchases through these exchanges. All other shareholders, however, can sell shares to the company through the order trading system. In book building, a merchant banker uses electronic bidding to determine the buyback price of the share. So how do you really get the profit here? Well, let's look at an example. Manganese ore mining company MOIL had bought back shares worth 693.7 crores last year. Now, this was done through the tender offer process. The company bought back the shares at the price of November 18 with a premium of 19%. The share price on this date was 172.35 rupees, while the company bought it at 205 rupees per share. Now, many bought the shares of MOIL from the market and sold it to the company and got a 32 rupees share profit. So what is Money9's advice here? First up, buybacks are less risky than IPOs because they involve knowing the workings of the company and fixing their fair price in the market. If you want to take advantage of buyback, then keep an eye on the stocks. Take advantage of the opportunity by seeing the difference between the share price and the buyback price in the market. On the go, opportunities for buyback are not fewer than IPOs. In 2020 and 2021, many companies had bought back their shares. That is, those who were smart made full use of the opportunity. But will the company buy all shares that you have? Well, there is a hitch here. To understand that, you must meet our formula guru, and then you will understand what exactly this will entail for you. So do stay tuned onto Money9.